Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro and my username is 𝗃𝗶𝗀𝗲𝗃𝗀𝗀. Thanks very much for listening to this video today, and as usual, please don't forget to put a like to this video and subscribe to my channel. I will really appreciate that. So to get started, last week was a very eventful week. We will know that with the recent bailouts of Silicon Valley Bank as well as Signature Bank, which were both just released today. And it was a very strange week in the market, to say the least. So I'm going to be talking about today in this presentation, explaining a little bit more about our portfolio, as well as talking about some of the ways that I may be able to mitigate some of that risk that is posed by that potential banking crisis. So let's get started. So our portfolio last week, although it didn't perform that well, if we compare it to other indices, it actually did reasonably well and held up quite well. So our portfolio was down about 3.69%. But if we compare that to the Nasdaq, which was down about 4.7%, and the S&P, which was down about 4.5%, I think our portfolio did reasonably well considering the turmoil that happened in the markets last week. As you know, the S&P 500 and the Nasdaq suffered major losses last week. Also, Europe and China continue to falter. Bitcoin and altcoins actually had a very tough start to last week. However, on Sunday, on the weekend, and also on Monday today, they have rallied back slightly, and they're about flat overall for the week. Our portfolio was also helped, and I think one of the main reasons for the overperformance is that I did some short-term positions and I had some success in trading the Spanish 30 index, as well as the UK 100, which is the FTSE 100, the 𝗳𝗂𝗶𝗀𝗃𝗃𝗀𝗀, which is the German indices, and also I had a short position in Doge. So they were all short indices positions. And what that's allowed me to do really is to be able to hedge out some risk. So the UK 100, the FTSE 100, and the Spanish 30, they're particularly very heavily weighted in financial services stocks. So by shorting those indexes, it allows me to be able to have a slight hedge on some of the financial services issues that are happening with these kind of bank bailouts and weak balance sheets from regional banks. So those have helped me. And if we look at our portfolio on a 2023 year-to-date basis, our portfolio is holding up pretty well. It's up about 10% overall for the year, and it's outperforming the Nasdaq, which is up about 6.4%, and the S&P 500, which is up about 0.6%. So that a couple of weeks ago was a lot higher. It was near about 10%, but that has gone down quite significantly over the last couple of weeks and is now very close to kind of flat. The FTSE 100 is still up about 3.98%, but I'm expecting that might go down in time, especially because it has a high level of financial services, and that's why I have some short positions in the FTSE 100. And the Hang Seng had a very bright start in January, but it's now down to about 0.12%, and Bitcoin has actually held up pretty well and is up 35.92% overall year to date. So if we look at the main news that happened last week, as I mentioned, the Nasdaq and the S&P 500 both crashed last week. And there was a couple of different reasons why that happened. So the first reason was that there was a speech by Jerome Powell, and he claimed that the path to disinflation will be bumpy, and that they may have to increase interest rates beyond previous expectations if data suggests it's required, because a lot of the inflation data started to point towards that inflation was coming down, but not quite at the levels that they wanted it to come down and at the speed they wanted it to come down. So that put some fears overall into the market and hurt sentiment. And then kind of later on in the week, it appeared and it showed that Silicon Valley Bank had started to have a lot of fears around it. and had a lot of fears around its solvency. And what happened really was that there ended up being a run on the bank. So there was a lot of fears that they weren't going to be able to honor the deposits of its customers. They also had a lot of investments in kind of longer term bonds. And what happened is a lot of their funding actually dried up, and they were actually forced to sell some of these bonds on the open market to be able to cover customers' payments at quite a large loss. And then what happened is, as the fear continued to rise, more and more people started to try and get their money out of the bank, and it caused a bank run. So what happened today, well, on Sunday in the US, but early today for other countries around the world, is that the US agreed to they're not calling it a bank, they're not calling it a bailout, they're basically calling it a backstop. So they're not bailing out shareholders or management like they did in 2008, but what they are doing is that they are ensuring that the customers' funds, so lots and lots of small businesses, especially in the technology sector, they have accounts with Silicon Valley Bank, and they're making sure that they are made whole, because if they don't, this could be a huge systemic risk, because a lot of small technology businesses in the US and further afield could go under, wouldn't be able to pay wages, etc., and this could cause a big spiral of issues. So they have agreed to do that. It's hard to be seen right now whether this is a systemic risk to banks all across the US, and especially those kind of smaller regional banks. There is a lot of talk that a lot of this was caused by bad treasury management by Silicon Valley Bank, by going into these kind of long duration bonds. However, we don't know what's bubbling beneath the surface a lot of these regional banks in the US. So I think it's very wise to be cautious about investing in banks, and I'm currently not taking any positions yet in these regional banks, although they are distressed, because we don't quite know what's going to be next. There was also Signature Bank, who has also had to be backstopped. The customer funds have had to be backstopped as well by the government in the same scheme. Signature Bank had become one of the largest banks for crypto-related companies to bank with. There's also a lot of legal firms and other such firms that banked with Signature Bank, and they have also been forced to close, and their customers have been backstopped as well. So let's just see how far that this can run into other banks, and whether we start to see any more strains on the bank. But it'll be very interesting to see what happens with interest rates, because interest rates were due to go up as the Fed continues to battle those high inflation rates, but it's to be seen whether the regional banks can actually cope with higher interest rates. And I'll go over that in a chart a little bit later. There was also some other news in the US with data which showed that there was an increase of 311,000 non-farm jobs in February. And actually this was well above expectations of around 200,000 new jobs. This just shows that there's still a lot of open jobs in the US, and that the job market in the US hasn't quite cooled down, even though interest rates have continued to rise. However, the unemployment rate rose unexpectedly, however, from a January 5 decade low of 3.4 to 3.6. So employment rate is increasing slightly, but it's still at really historic levels, and there is still a lot of open jobs, especially in the services sector. Eurozone economic growth in the fourth quarter was revised down to 0% from an estimate of 0.1%. So not much of a difference there, but it just shows that those the economic growth of Europe is expected to slow down. And this has led to, however, with inflation issues in Europe, it's led to the ECB chiefs still calling for higher interest rates all throughout Europe. So this is a very contentious subject at the moment. The UK also has rebounded by more than expected in January. This is mainly driven by the growth in the services sector and GDP rising 0.3%, and that's after a contraction in December. So it's just showing that the UK economy is starting to bounce back slightly. There was also several key important meetings in China last week, and China set an economic growth target of around 5% at the recent National People's Congress. The target did lag what most forecasters were suggesting that could happen, and that represents a recovery from the 3% growth rate last year. So although it is below what the expectations were, it's obviously still above what the growth rate was for last year. But it is to be noted that last year and the year before were very special and unique years with COVID-19 and a lot of the lockdowns in China. We also saw at the same meeting, Premier Li Keqiang, he said that China would continue to seek to ensure economic stability and expand consumption this year. And they want to strive to become a mid-level developed economy by 2035. China also reported that its consumer price index rose 1% in February, and that is from a year earlier, which trailed forecasts down from a 2.1% rise the previous month. So just showing that there is some strain overall in China as well, despite the reopenings. So I'm not going to go over, as usual, the top 3 performing stocks of last week. And that is because no particular stocks actually performed very well last week because of all the issues in the market. So I'm going to swiftly move on today to our Death by Charts edition. And I have added an extra chart for your viewing pleasure. So we are going through 5 charts today. The first chart to the left, I just wanted to show you the real scale of the Silicon Valley Bank failure, and that shows that it's the second largest bank failure in history, and that's only just behind the bank failure of Washington Mutual in 2008. So this Silicon Valley Bank, at the time of it going under, has assets at 209 billion. Only the Washington Mutual was higher than that at 307 billion. So this is the biggest bank failure since the global financial crisis in 2008. So it really shows you the scale and why it was important for the US government to intervene. I also wanted to go over another chart to the right, and this is the largest weekly declines in the S&P Regional Bank ETF. So this ETF measures the performance of all of the smaller regional banks in the US. And what it showed is that the 16% decline in the regional bank ETF last week was the 4th largest since its inception in 2006. Only the financial crisis in 08-09 and the COVID crash in March 2020 saw larger weekly declines. So as you can see, there is a lot of panic overall in these banks. And that is mainly because we don't really know what the systemic risks are behind potential cascading banks going under over the next couple of weeks. So it's very important to keep an eye on that. And then the third chart that I wanted to show you was the interest expense on the US public debt outstanding. And this shows that the interest expense on US public debt has rose to 787 billion over the past year, which is a record high. And if it continues to increase at the current pace, it will soon be the largest item in the federal budget, which surpasses Social Security. So as you can see, as interest rates continue to rise, this puts a real strain on US public debt, because it means that their interest payments are higher because of those interest rates increases. So it just shows really that the longer that this goes on and the higher the rates go and the longer that the interest rates remain elevated, the higher the debt payments are going to be, which is going to have pressure on the US economy as a whole. Fourth chart I wanted to show you to the right is the US labor force participation rate. And as you can see, we had continued US participation rate until around that kind of July 2000 mark. And then from there, we saw lower and lower participation rate. And we saw a big drop off in the labor participation rate in that kind of COVID period in 2020 and 2021. And that is because the stimulus payments were much higher and less people wanted to work. People also had to look after children, etc. during COVID, and there was less incentives to people work. But now, as we're seeing higher inflation, higher interest rates, and a higher cost of living, this means that more people have had to go back to work. So that has been slowly rising over the last 6 months or so. Last chart that I just wanted to point out, and I think that this is really important. So this is the target probabilities for the 22nd of March, the Fed meeting, so the FOMC meeting. And it's now really showing that there's almost a zero likelihood of a 0.5% increase. Just a few days ago, maybe on Thursday or Friday, after Jerome Powell's original speech, it was actually the odds and the expectations of a 0.5% increase had increased as his last speech was more and more hawkish. However, since these bailouts for the banks, what we've actually seen is that there's now a 19.5% chance that the Fed doesn't raise rates at all. That wasn't even in the equation last week. And now it's saying that there's an 80% chance that the Fed raises by 0.25%, which is the consensus. And this is mainly because people really doubt that the banks are going to be able to cope with increased interest rates. And I think it's always been said that it's quite likely that the Federal Reserve were going to increase interest rates to the point where something might break in the economy. And the reason why they had to do that is because they had their target inflation rate of 2%, and they were trying to meet that figure. But as the interest rates stay sustained higher for longer, this forms more cracks in the banks, and it is very doubtful at the moment whether the banks can actually cope with increased interest rates. So let's see what happens over the next couple of months. But I think we could see a reversal in the interest rate policy potentially over the next couple of months. So the last thing that I wanted to talk about was crypto. And as I mentioned, crypto had a very up and down week last week. So at the beginning of last week, it had a lot of difficulties, and we actually saw Bitcoin actually drop below that 20,000 level. It was down at about 19,800 or something like that. And that is mainly because of what has actually been dubbed Operation Choke Point. And what that means is that the US government, especially the SEC, they more and more having clampdowns on crypto-related companies. And what they're really doing is they're trying to choke the crypto-related companies by cutting them off from the banking system. So we all know that Silvergate had problems over the last month or so, and that has kind of taken offline one of the key banks that crypto companies had to bank with previously. And now we have seen Silicon Valley Bank and Signature Bank, who were very heavy crypto banks. They also have now run into difficulties and they've had to be bailed out, and those companies no longer exist anymore. So really what that's doing is it's actually stopping the on-ramps and off-ramps of crypto, and it makes it much more difficult for not only the crypto companies to be able to have access to traditional banking, but it's also making it very difficult for the regular customer, the regular retail customer, to be able to invest money and convert money from fiat and get the money onto crypto exchanges and to be able to move into the crypto economy. However, it's not that the first time that this has happened. And we've seen over the years that the Bitcoin and the crypto community, they always find a way. And I think what you'll see is you will see when there's opportunity and when there's a lack of entrance in the market, you'll see potentially new participants moving into the market to fill the gap of some of these previous failed crypto-related banks. So it'll be quite interesting to see that, but I think it could have some short-term headwinds on the crypto market in the short term. We also saw later on last week, we saw that USDC, which is run by Circle, so it's basically a stable coin. They actually depegged last week, which was another reason for crypto to go down towards the end of last week. And the reason why they depegged is that it was actually said that they had some of their reserves, the US dollar reserves, which backs the USDC coin, were invested in Silicon Valley Bank. And it was not sure whether they'd be able to get those funds back because the bailout hadn't yet been announced. But now it's been announced that people are, everyone's going to be made whole. All their customer accounts are going to be made completely whole. So now that USDC peg has now almost got to parity at $1. However, it just does show that I think a lot of people were talking last year about algorithmic stable coins and how they weren't backed by anything, and why it was much better to be invested in USDC and in Tether, in other stable coins which were backed by fiat currency. However, it just shows you that all those funds that have to be backed are basically in banks. So that gives you a central point of failure. And whenever there's a central point of failure, and we all know that the biggest issue with banks is fractional reserve banking, and you always have the potential for these run on the banks. So even with stable coins such as USDC, which is backed, there is still inherent risk that is involved. We also saw Ripple last week, and they've actually announced as well that they had some money held up in Silicon Valley Bank as well. However, again, now that all customers' monies are going to be made whole, it's a lot less of a risk. But I think it's very important, if we look at crypto as a whole, to be mindful that there are a lot of potential selling events that might happen in the short term, and that there is a little bit of an increased risk at the moment. So really what I'm doing in terms of my crypto positions at the moment is that I'm actually holding tight with the positions that I have. And as prices, if prices go down from here slightly, I may start to nibble into the market and may start to take positions, because my overall goal and my strategy with crypto is that as positions go down in value, I actually increase my exposure to crypto, because then I see much a more asymmetric upside. And then when prices go a lot higher, then I trim those positions because I see less upside in those positions. So that's the main way that I manage my crypto positions. Last chart that I just wanted to show you, and really just wanted to demonstrate that the Bitcoin halving is really only a year away now. And what, as you will know, if you're a beginner to Bitcoin or crypto, what happens is every 4 years, the reward for miners are actually cut in half. So what this does is this causes a supply shock. And as you will see from those charts, you see those checkered lines through the years. So the second halving happened in July 2016. And what you saw there was after that halving, you saw an increase in price. So what usually happens is about 6 months before the halving, you start to see a slow rise in Bitcoin prices as people start to price in and anticipate that halving. We also saw a very similar pattern that happened after the third halving in the May 11th, 2020, a similar rise up just before, and then a more larger rise up to a peak of about 18 months after that halving. So the next halving is coming up in March 2024. I expect a similar pattern to actually play out. I'm not expecting all-time highs until at least after that March 2024 halving. However, I do still see some upside, especially in the second half of this year as we kind of come to that 6 months before the halving. And I do think that prices will be higher towards the end of this year. However, it's very important to note that in the short term, there is potentially some selling pressure that could occur, and that there is going to be some volatility. So I think if you're holding Bitcoin now, it's very important to have a long-term perspective. And I think that you've held on to your crypto positions for this long, especially in the depths of the bear market. And I think within the next couple of years, you should be rewarded for that risk that you took, and also the conviction that you showed in your Bitcoin holdings. So thank you very much for listening to my video today. I know that the last week or so has probably been quite scary, especially to some of you new market participants, especially those that weren't in the market in 2008, 2009 during the Great Financial Depression, in which banks had to be bailed out. I think it's very important that you take kind of a long-term investment perspective, and that with some of these drops in the market, that there are potential opportunities to take advantage of. And a lot of it is about time in the market rather than timing the market. However, I will continue to place some hedges in the market to try and reduce some of that volatility that may persist over the next couple of weeks or couple of months. So thank you very much for listening to my video today. Join my Discord group if you haven't done so already. Awesome group, awesome community of people regularly chatting about all things the market related, all things crypto, and you can ask me any questions at any time. So until then, have a great week ahead.